Greetings, wise investors and financial enthusiasts. Welcome to Investor Web, your trusted guide on the road to financial freedom. Here, we aim to provide you with valuable insights, thoughtful perspectives, and practical strategies to navigate the often complex world of finance and investment. We believe in empowering you with knowledge to make informed decisions that can shape your financial future. Today, we're diving into a topic that may seem counterintuitive at first glance: how saving money makes you poor. Yes, you heard it right. In the next few minutes, we'll challenge traditional notions of wealth accumulation and shed light on why the conventional wisdom of save money to grow rich may not always hold true in today's dynamic economic landscape. From understanding the power of investing to the importance of diversification and risk management, we're set to embark on an enlightening journey. So buckle up and stay tuned to uncover the hidden truths behind saving money. Saving money, a concept we've been taught since childhood, but is it really the road to wealth? Let's delve into the traditional saving paradigm that has been etched into our minds over the years. Most of us have been raised with the idea that saving money is the key to financial security. This notion might have originated from our parents or grandparents who lived through times of economic uncertainty. They saved every penny, hoping to build a safety net for the future. Let's take a look at John, a case study who represents many people following this old school of thought. John diligently puts aside a portion of his income into a savings account every month, believing that this will lead to financial growth over time. However, John's savings account offers a low interest rate, barely keeping up with inflation. Inflation is the silent thief that erodes the purchasing power of our money over time. Imagine this: a loaf of bread that cost £1 a decade ago now costs £1.50. This is the effect of inflation. Now apply this inflation rate to John's hard-earned savings, and you'll notice that the real value of his money is shrinking, not growing. John isn't alone. Countless individuals are stuck in this traditional saving paradigm, watching their money's value diminish over time. The irony is that while they believe they're growing their wealth, they're actually experiencing financial stagnation. Moreover, the interest rates on savings accounts have been at historical lows for the past decade or so. These low interest rates, coupled with inflation, make the traditional saving method far less appealing. Where does this leave us then? Well, it's time we question this traditional saving paradigm. We need to explore other avenues that may lead to real financial growth, that can outpace inflation and offer potential for higher returns. As we can see, traditional saving methods may not always lead to financial growth. It's time for a change, a shift from saving to investing, but more on that in the next segment. Stay tuned. Rather than letting your money sleep in the bank, have you considered making it work for you? With this question, we delve into the powerful realm of investing. You see, investing is akin to planting seeds today to reap the fruits tomorrow. It's the process of allocating your hard-earned money in ventures, stocks, bonds, or real estate with an expectation of generating returns in the future. Investing is not just about piling up wealth, it's about generating a flow of income even when you're not actively working. This is what we call passive income. It's the secret sauce that makes the rich get richer. They make their money work for them instead of working for money. Let's take a look at some case studies to illustrate this point. Consider the story of Warren Buffett, one of the world's most successful investors. He started investing at the tender age of 11 and has since built a fortune worth billions. Buffett's investments in companies like Coca-Cola and Apple have consistently provided him with a steady stream of income. Or let's talk about the thousands of everyday people who invested in companies like Amazon or Tesla in their early days. These individuals, who may have started with modest amounts, have seen their investments grow exponentially, turning them into millionaires. Now, it's important to note that investing isn't a guaranteed path to wealth. There are risks involved, but the potential for financial growth far exceeds that of traditional saving methods. Banks offer minimal interest rates, barely enough to keep up with inflation. In contrast, investing in the stock market, for instance, has historically provided an average annual return of around 7%, significantly outpacing inflation. Investing isn't a get-rich-quick scheme, it's a long-term strategy. The key is to start early, be patient, and let the magic of compounding work its wonders. With time, even small, regular investments can accumulate into a substantial nest egg. Indeed, investing provides an opportunity for your money to grow exponentially over time. It's about making your money work for you, not the other way around, and that, friends, is the power of investing. Investing might sound risky, but with the right strategies, you can manage and mitigate these risks. Now let's dive right into one of the most effective ways to mitigate investment risks: diversification. Imagine your investment portfolio as a garden. If you only plant one type of flower and a specific pest comes along that destroys that flower, your garden is ruined. But if you have a variety of flowers, that pest might destroy one type, but the rest of your garden will continue to flourish. This is the essence of diversification. By spreading your investments across a wide range of assets, you're less likely to lose all your money if one investment performs poorly. Now let's bring in some real-world examples. Consider the case of an investor who put all their money into technology stocks in the late 90s. When the dot-com bubble burst around the year 2000, they would have seen a significant portion of their wealth wiped out. But an investor who had diversified their portfolio across various sectors and asset classes would have weathered the storm much better. But diversification is not just about spreading your money across different sectors. It's also about diversifying within each asset class. If you're investing in stocks, don't just buy stocks from one company. Spread your investments across multiple companies and industries. If you're investing in bonds, consider a mix of government, municipal, and corporate bonds, and let's not forget about geographic diversification. In today's interconnected world, it's easier than ever to invest in foreign markets. This can provide a buffer if your home country's economy hits a rough patch. The goal of diversification is not necessarily to boost performance. It won't guarantee gains or protect against losses, but it can help you to reach long-range financial goals while minimizing risk. Remember, diversification doesn't eliminate the risk of loss. It can only help manage it. It's a strategy that aims to smooth out unsystematic risk events in a portfolio, so the positive performance of some investments neutralizes the negative performance of others. Risk is a part of the investment game, but with diversification you can play it wisely. So make sure to diversify your portfolio and manage your risks effectively. It's an essential part of being a savvy investor. Now that we understand the limitations of saving and the power of investing, how do we make the shift? This question may seem daunting, but rest assured it's a journey that's both attainable and rewarding. Let's start with a simple but crucial step. Start small. You don't have to be a millionaire to be an investor. In fact, many successful investors started with a modest sum and built it up over time. Begin by setting aside a small portion of your savings to invest. This can be as little as 5% of your monthly income. The key here is consistency. Over time, this small percentage can grow into a substantial nest egg. But investing isn't just about throwing money into the stock market and hoping for the best. It's about making informed decisions. This brings us to our next step: educate yourself. There's a wealth of information out there about different investment options. Books, online courses, podcasts, blogs, the resources are endless. Spend time understanding the basics of stocks, bonds, mutual funds, real estate, and more. Knowledge is power, and in this case, it's also wealth. Yet, as we navigate this sea of information, it's easy to feel overwhelmed. This is where our third step comes in: seek professional advice. Financial advisors can provide guidance tailored to your specific needs and goals. They can help you create an investment strategy, manage risks, and keep your emotions in check. Remember, investing is a marathon, not a sprint. It's about long-term gains, not quick wins. Lastly, be patient. The transition from being a saver to an investor is not an overnight process. It takes time, effort, and a fair bit of resilience. There will be ups and downs, victories and setbacks, but don't let these deter you. Keep your eyes on the prize and stay the course. Remember, the shift from saving to investing doesn't happen overnight, but the journey is well worth it. So let's embark on this journey together and create a future where your money works for you, not the other way around. Let's take a moment to reflect on what we've learned today. We've unraveled the traditional saving paradigm, which, while safe, often results in stagnant wealth. In contrast, investing, when done wisely, can be a powerful tool for financial growth. We've explored the concept of diversification and underscored the significance of risk management in investment. Remember, it's not about putting all your eggs in one basket, but spreading them across various promising baskets. We've also discussed the critical shift from saving to investing, emphasizing that the key to wealth accumulation is not merely saving, but smart investing. A savvy investor knows that money saved is often money wasted, as inflation erodes its value over time. In sum, If you want to see your wealth grow, consider investing, not just saving. Thank you for joining us on Investor Web. Don't forget to subscribe for more financial insights. Remember, your wealth is in your hands.